It's pretty wild how just one day, a couple of really startling headlines can send an absolute chill down Wall Street's spine. And that is exactly what just happened in the world of banking. Suddenly, fears of bad loans and even fraud have put everybody on high alert. So, what's really going on here?
All right, let's get right into it. The whole thing really kicks off with this one event that made the entire market just sit up and pay attention. We're talking about a sudden, sharp drop that felt a lot less like a little dip and a whole lot more like a nosedive. So get this. On a single Thursday, the KBW Regional Banking Index, that's basically the stock market's pulse check for America's smaller banks, it plunged a staggering 6.3%. Wow, that is its worst one-day performance in months. And a drop that steep, that fast, it just makes you ask one thing. What on earth caused this level of panic?
Well, this wasn't just the market having a bad day out of nowhere. No, this sell-off was a direct reaction to some really specific and pretty troubling news. It came from two regional banks, and they were raising alarms about potential fraud deep inside their loan portfolios.
Okay, so here are the two sparks that lit the whole fire. First up, Zions Bancorp comes out and says it could lose over $60 million on a couple of loans because of, and I'm quoting here, misrepresentations. Then you have Western Alliance, and they reveal they're suing a borrower to get back around $100 million, also alleging fraud. I mean, when banks start throwing around words like fraud and misrepresentation, investors get very nervous very fast.
Now, here's what's so fascinating about this. Why was the reaction so extreme? Well, it's because this didn't happen in a vacuum. The market has a very fresh and frankly a very painful memory of banking turmoil. It's like everyone was already primed for the worst case scenario.
In this timeline, man, it just lays out the building anxiety perfectly. It all started back in 2023 with those shocking collapses of Silicon Valley Bank and First Republic. Then, just last month, a couple of major bankruptcies in the auto industry raised all these new questions about lending standards. So you see, when Zions and Western Alliance made their announcements, it felt like the third shoe dropping in this really unsettling pattern of instability.
So this brings us to the big debate happening on Wall Street right now. The crucial question is this. Are these new fraud cases just a couple of unlucky one-off incidents? Or, and this is what people are afraid of, are they the first sign of a much bigger hidden problem?
That fear, it was captured absolutely perfectly by JP Morgan's CEO Jamie Dimon. His warning that when you see one cockroach, there are probably more. I mean, that has become the defining metaphor for this whole moment of uncertainty. It just speaks to that deep-seated fear that these individual problems aren't individual at all, but a symptom of a much wider infestation in the credit markets.
And this just lays it all out. You've basically got two competing stories on Wall Street. On one side, you have the cockroach theory, right? The fear that this is just the tip of the iceberg, that it's the beginning of a broader credit problem, a fever, as one analyst called it. But then, on the other side, you've got the argument for reassurance, that, hey, these are just isolated, idiosyncratic events, and that the banking system is actually fundamentally sound.
But not everyone is jumping on the doomsday bandwagon. Actually, there's a whole chorus of voices pushing back, saying the panic is way overblown. You've got top bank execs, like Fifth Third CEO, saying point blank, this is not like the 2023 crisis. You have research firms pointing to solid earnings reports that show credit quality is actually improving overall. And maybe the biggest tell, the market itself bounced back a little the very next day, with the index regaining 1.7%. That kind of suggests the initial shock might have been an overreaction.
So with these two completely different stories battling it out, the future feels, well, pretty uncertain. But all of this pressure, all this volatility, it's speeding up conversations around one very specific outcome for the banking sector: consolidation. And the logic here is pretty simple. When smaller banks feel the heat, selling to a bigger rival suddenly looks like a really good option. It could mean fewer local banks, but it creates these giants that are just better equipped to handle a storm. As one analyst put it, size can be a real defense, making bigger banks better able to soak up unexpected losses. And with a regulatory environment that's seen as more open to these kinds of deals, the stage is pretty much set for a wave of mergers. And look, this isn't just some theory. Check out this number, 51. That's how many bank deals were announced in the third quarter alone. That is the highest total in 4 years. So this trend, this move toward consolidation, it's not a possibility, it's happening right now, and it is picking up steam.
Which, of course, brings us right back to our main question. Are we watching the early symptoms of a widespread fever that could really shake up the entire banking industry? Or is this just a fleeting chill, a brief moment of panic that's going to pass once the market remembers the system's underlying strengths? Honestly, the answer is still unfolding as we speak.